Are you looking to start investing in the Kenyan stock market? We have just the solution for you. Introducing Dosika, a mobile app that is designed to make the Kenyan capital markets accessible to everyone with a simple to use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Here's how to sign up. Download and install the Dosika app from the Google Play Store. Create a Dosika account by signing up with your email address and phone number. Once you've signed in and linked your account, you are all set to start adding securities to your watch list or portfolio. To track the performance of your portfolio, go to the Portfolio tab and view your holdings. Dosika ni investment chap mkononi. Dosika, grow your wealth. Are you looking to start investing in the Kenyan stock market? We have just the solution for you. Introducing Dosika, a mobile app that is designed to make the Kenyan capital markets accessible to everyone with a simple to use interface. The app provides real-time updates on stock prices and news, which is crucial for investors. Here's how to sign up. Download and install the Dosika app from the Google Play Store. Create a Dosika account by signing up with your email address and phone number. Once you've signed in and linked your account, you are all set to start adding securities to your watch list or portfolio. To track the performance of your portfolio, go to the Portfolio tab and view your holdings. Dosika ni investment chap mkononi. Dosika, grow your wealth.
Nasikia kuna app fulani inaitwa Dosika that allows you to get market insights, unaweza trade na pia unaweza ona portfolio yako huko ndani. I think that would be a great idea for us.
Dosika ni investment chap mkononi. Dosika, grow your wealth.
Good evening, everyone, or good morning, good afternoon from wherever you're tuning in from. Welcome to the CDSE webinar. This is our first webinar for this month and our second, I think, for the year. Thank you for making time, and we'll just get straight into it. We have a very good host or a very good presenter to tonight. His name is Christopher Aura, and he will just introduce himself. But before he does that, I can maybe just introduce you to what CDSE does, and maybe why it is important for us to have these sessions. So CDSE is quite simply put, we call ourselves the bank of shares. When you buy or when you want to buy shares in the capital markets, specifically for the Nairobi Securities Exchange, you need a place where that share is held, and it's held in what we call the Central Depository System account, short form CDS account. So probably most of you or all of you who are here have CDS accounts, and we are the custodians of all your securities. We hold almost 2 trillion worth of assets. That is all the securities in the market, both those ones that we call immobilized, the ones that are in the CDS, as well as holdings or records of those that are still in paper certificate. And we urge you, if you still have shares in paper certificate, to please engage your stockbroker to start the process of getting them stored in electronic format, because From experience, it is usually very tedious and a very lengthy process for you to transfer those assets in case of demise or in case you want to trade. So you want to do it now when it's easier and probably when you still can. So that's just on the side note. But CDSC basically holds all your shares, and we facilitate the settlement. That is, when you buy or sell securities in the stock exchange, we handle what we call the post-trade services, which is now after you bought those shares in the Nairobi Securities Exchange through your stockbroker, then how does that share move from the person who sold that share to your account, and how does that money move from their account to your from your account to the guy who sold you those shares. So we handle post-trade services, including settlement. We also have the product called securities lending and borrowing. We can talk about that later. And we have Dosika. For those of you who have not traded for a while, there is an app that you can use to open an account and trade easily and conveniently, and we shall maybe be talking about that later. But the purpose of this video is for those of you who are investors or who want to get back into the trading space. A lot has been happening since last year. A lot of companies have been posting very positive results, a lot of happenings or a lot of market activity, including the lifting of suspension of KQ. So the market has been very vibrant, or the market has had a lot of activity. Stocks have gone up, others have gone down, and probably you are thinking about how do you position yourself for growth in the year 2025. So we shall be looking at 2024. The companies that released their results just last month, including the banks, the insurance, the manufacturing companies, as well as then what that means for you as an investor going into 2025. But without further ado, I'll just like to welcome my speaker for the night, Christopher Aura, who will just introduce himself, and then we can carry on from there. Chris.
Thanks, Steve, and everybody who has made time to be here with us today. Steve has captured well the reason why you are here today. And first of all, in terms of introduction, my name is Christopher Aura. So it can be Aura or Aura, depending on where you're coming from. So today I work with NCBA Investment Bank as a research analyst in the brokerage division. So for brokerage, this is where we help investors buy and sell shares and also invest in fixed income market. So for we are just today, what Steve has said, we're just going to look into 2024 financial performance of the select sectors and how these performance can drive your decision moving into 2025. With that, I just share my screen and we'll start the conversation together.
So, sure. And as you share, Chris,
yes,
somebody might be wondering, why are we talking about 2024? It's because while 2024 was 3 months away, the companies released their results just a few weeks ago, and now we're trying to discuss what that means for the people going forward. So it's not that we're giving you very outdated information. It's just that those companies, most of them released it in the month of March, the late March, and now we are trying to see what that means for investors, because there are several things that have happened since January that are probably worth your attention. So take it away, Chris.
Yeah, thanks, Steve. Just to mention in terms of what we call earnings calendar. So like for banks, their financial year is usually between January to December. And so once it has ended in December, they take like 2 months, 3 months to release their full year results by March. The same goes for insurance sector. And for some manufacturers, the financial years between January to December, and some is from June to June. So that's why you see the results are released like in March. And for banks, it's usually on a quarterly basis. For insurance, it's usually on a half-year basis. So that said, today our conversation will dwell, as Steve has introduced, financial 2024 highlights and how this might drive your decision making into 2025. So what we're going to do, we are going to look at the sectoral analysis, just at the banking sector, and we are also going to look into manufacturing and also insurance, how they are performed, what drove their performance, and their future outlook and the challenges within such sectors. After that, we'll also look at the trends in the market and what's happening, and the stock recommendations, the top 3 stocks that you can look into, and how we come up with the stock recommendations. So that said, I'll just start, and I hope you can see my slide clearly. Steve, you can confirm that?
Yes, we are on slide 2.
Okay, that's fine. So I'll start with the banking sector. But before looking to banking sector, we are just looking at the overall market performance in 2024. So for this one, we are going to look into how the index performs. So we have 4 indices in the Kenyan equities market. That's NASI, NSE 20, 25, and 10. And the NASI is the one that covers the entire market. NSE 20 covers specific 20 counters that are like types of market capability, the largest 20 counters, similar to NSE 25. Then NSE 10 looks into the most liquid blue chip stocks in the market. So from this, you can see that for full year 2024, that's from January 2024 to December 2024, the entire market really gained, and NASI was at 34%. So this was because there were improving macros towards the end of the year, and also dividend expectations from the banking sector. So from around November to December, there was a rally in the banking stocks. And so this might be one of the reasons that led to the entire market performing better. But year to date, we have seen some of the gains being lost. So far, NSE 25 has recorded a loss of 0.4%, same to NSE 10. So for this, just showing that there's a stock, investors are rotating their stock, the ones that in terms of their investment selection. So that's the entire market. Now we start with the banking sector. So for banks, first of all, in this side, we're just looking at the performance, the share performance. That's for full year 2024 and also year to date. So for full year 2024, banks shares really performed well. That's capital gain. So one of the reasons for this is there was expectation of good dividend yield from the banks. This is their trend. They have been paying good dividends, as we will see down there. For the last 5 years, they've been consistent. And one of the banks, the top performers here were I&M Group and also KCB and Stanchart. For Stanchart, the main reason for the stellar performance is because they have been paying good dividends at around a 5% dividend payout. For KCB and for I&M was coming from undervaluation point of view. It was around from 20. So the base effect played a key role on the performance, but also the bank has been really investing in digitalization and also improving their creating their presence out there by having more branches. For KCB, they were coming from the poor performance in 2023 after injecting more capital into NBK. That's National Bank after they acquired it. So their performance in 2023 was not that good. So from that, they improved and they came from downs of around 2020s to 40s. So that's why the performance was that good. But if we see year to date, that's from January 2025 to as of yesterday, 15th, we see that the stocks that have maintained performance so far against Stanchart, DTB Kenya, and Stanbic. This is mainly because investors have already seen the results, the full year results, and also they have come up. They have made decisions now, which either to lock in their profits or to wait for dividends. So we'll see more corrections after books closures. That will start from this period to May. After books closures, the stocks will be correcting. And so far, Stanbic, DTB Kenya, and Standouts are maintained, but you can see KCB has started correcting, and it moved from the highs of 43 that it was to around 37, 38 currently. So that's how the stock is performing. And now for here, we're looking at like the performance of the sector and what were the key growth drivers. And one of the things that we see in terms of profitability, for all the tier 1 banks, for tier 1 banks, I mean that's the banks that are the listed ones and the ones that have higher capital buffers. All of them made a double-digit profit. And from the chart that I've shared here on my right-hand side, you can see that KCB was one of the is the company that grew the largest in terms of profitability, both in percentage and also quantum. It grew by 66%, and as followed by Stanchart, which grew by 48%. So for this, let's just look at some of the factors that drove this the good performance, the impressive performance that we saw for the full year. One is higher interest income. So for 2024, we know that we were having an elevated interest rate environment. And for this, banks gain a lot from their investments in government securities, because they are in 24, that's when we saw IFBs going at around 17, 18%. So from that, they made huge income from that. And also we saw the banks had implemented a risk-based pricing model. So for risk-based pricing model, the bank will lend you a loan based on your credit quality. So if you have a poor credit rating or a low credit rating, they'll lend you but a higher rate. So this has also been beneficial to them. And one of the main things that also helped them was the elevated lending rates. Though right now we are seeing the interest rates are easing, and already there's banks are trying to lower their rates in the market. But this was also a blessing, but also it was a problem, because it led to most of the non-performing loans in the market, and also led to high cost of funds. That's the expensive deposit that we are witnessing. So another driver was focus on revenue diversification. Banks are really diversifying from the normal role of a role of a bank, that's lending and deposit taking. Right now, banks are moving to asset management, insurance, such as that's one. NCB is an example, and also equity has also moved to insurance. And also adoption of digital channels and automation. KCB also even reduced some of their branches to automate and reduce that cost they are involved in CapEx. And also efficiency, they have been trying to improve the efficiency. This has also been witnessed so far from Stanchart and Stanbic. They have been really efficient. And the economy, despite it struggling in 2024, it remained resilient and is projected to grow by 4.7%. So this one at least helped in the growth. And now just for this slide, we're just looking at some of the main line items for the banks and how they performed. So for this year, one of the key things to note is that in 2024, loan for the entire all the listed banks, their loan reduced. So one of the main reasons for this was, as I've said, because of the high lending and high interest rates for lenders. So most of the lenders were shying away from going for the loans because they were expensive, and also the non-performing loans in the market, because the banks were experiencing a high level of defaults. They were also shying away from giving out loans to private sector. And also you can see that because of the high interest rate environment, also most banks had preferred to give their money to the banks and the high interest on government securities. But also another key reasons for this was the Kenya shillings appreciated last year by almost 20% from 160 to 120. No, now most of the banks are like have a 30 to 40% exposure to foreign currency, that's USD. Now, if you convert it to local currency, there was a reduction in value, so that might also be one of the reasons. So this also goes to deposit, because people, if the private sector don't have money, they won't give you money to have as their deposits. So that was that was a key thing to notice. So the loan and deposit are reduced. But in terms of asset base and capital, all the banks are all the listed banks are well capitalized, as we can see here. Now we move to one of the key things that has affected the banking sector. The main challenge for the banking sector has been the non-performing loan. So these are the bad debts, those who have been given loans, but they have been unable to pay. So one of the reasons for the non-performing loans in the market, we've all been hearing about the pending bills. The government owes private sector around 800 billion. So this private sector, that's the corporations, they are the ones that lend from the banks, and they need to be paid for them to pay back the banks. But this has been an issue for the longest time possible. But now we are hearing that the government is planning to float a bond. Maybe if they manage to pay, then we will see the non-performing loan ratio reducing. Because currently, as of December 2024, it was at 16.4. Right now, it has moved to 17.2. So that's showing you the credit quality in the market is really bad. And this has affected KCB, KCB and the CHF. They are the most affected companies, and also National Bank of Kenya. So that's the main challenge that's affecting the bank, but also high cost of funding. That's because deposits are also high. But with the interest rates reducing, we wait to see what it entails. In terms of efficiency, the banks have been really trying to be efficient. And this we can see from their cost to income ratio. They are trying to reduce unnecessary expenses and also to ensure that their NIMs, that's the net interest margin, and the profitability is not strained. Yeah, so for in terms of dividend, this is where most of the investors usually concentrate on. Fortunately, is that the banking sector in Kenya, they have been good good in terms of dividend payment. So from here, the way your company pays dividend depends on their objective. So you'll see that some companies pay like 80% of dividends because these are companies that don't have capex expenditures. They don't want to expand, maybe move into other markets. So that's why you can see here. Since 2021, all the banks have consistently paid dividends, except for KCB in 2023. And in terms of the largest dividend payers, Standard Chartered is the king here. For their full year 2024, they paid 45 Kenya shillings per share. That's around 85% dividend payout. So from the income they earned, the net income, they paid 85% to their shareholders. Stanbic has also been good in dividend payments, while Absa Bank also. But one company that has low dividend payment is KCB, despite them making a huge profit. This is because their subsidiaries are still trying to improve to grow. Then they also have they want to expand. So most of the income are still going to those projects. That's the reason why their dividend payout was 16%. The same goes with equity. Equity, the dividend payout policy should be around 30 to 50%, but you saw that they gave 34%. So this means that they still want to expand into other markets, into different sectors. I've still seen they're in DRC, Rwanda, Tanzania, Uganda. So they still have that growth perspective. But generally, the dividends within the banking sector was good. That's why you saw the prices rallying. And dividend coverage also, Standard Chartered has the lowest because they have already paid most of the amount to their clients. So dividend coverage is just showing you how many times can the bank use the earnings they have to pay the dividends. So that's it. Let's move to another. That's like this. These numbers are just for valuation. So we have price to book and price to earnings. Price to book is just showing you the comparison of the current market share price against the book value. Book value, these are just the net assets. So far, Absa Bank and Standard Chartered are trading slightly above their net book value, while the other banks, Cooperative, KCB, and Equity, all of them are below their value. So the market is slightly undervalued. The banking sector is slightly undervalued. Even if you look at in terms of price to earnings, is also just showing you how much investors are willing to pay for the income that they are getting from their investments. So this is just showing us that the banking sector is still undervalued, and so there's still value here. You can look into stocks that you might prefer and buy from this because their true value is still yet to be discovered in the market. So looking into the future, 2025, in terms of growth, we expect the banking sector to continue growing at a steady rate. This will be boosted by, we expect the credit to private sector to improve in 2025. This is because the central bank has been trying to lower the interest rate in the market, and this has shown that we have seen banks continuously lowering their lending rates. So within time, creditors will be able to access credit, and if they access credits, income from loans will also grow, so banks will also earn. And so we expect from the diversification that the bank has witnessed, an interest income will also improve. This from the asset management, insurance, bank assurance, and also such stuff. Capital and liquidity, the banks, the tier 1 banks are well capitalized, though we have the new rules that require banks to have a threshold of 10 billion by, I think, 2027. So there are still 14 banks that need to improve on that, but we'll see that. Then also interest rate risk. This one is still there, but with the interest rate environment that we're currently witnessing, it will ease out. Credit risk is still an issue, with NPLs going further to 17.2. So this one is dependent with the government paying their suppliers the pending bills, the 800 billion. Once it's paid, at least it will ease the burden. Then also net interest margin, we expect the profit margin to be a little bit strained because of the challenges that we have seen, the high cost of funds, the non-performing loans, and the need for provision. So that's for the banking sector. And now we move to manufacturing. So for the manufacturing sector, this is where we have companies such as ABL, and also we have the likes of Carbasid, we have BAT, that's the British American Tobacco. So for this, our case study will just be on two companies. That's BAT Kenya and ABL. So BAT, as we all know, their main product is tobacco, and ABL produce the alcohol that we use, beers, spirits that we use in Kenya. So in terms of this, also we just look into in terms of share performance for year to date and also full year. And so far, ABL is one of the top performer compared to BAT in 2024, with the ABL gaining by around 53%, while BAT was only gained by around 7.7%. And also year to date, the trend continues with the ABL gaining, though at a lower rate at 2%, while BAT recorded a loss of 1.1%. So the thing is that for the manufacturing sector, it has been hit hard by the adverse macros that we've had in 2024, and also because most of these are consumer companies. They produce products that are being consumed by individuals. So if people don't have enough income, the products such as alcohol will become an opportunity cost. So people will first of all look into food. So the high inflation that we witnessed, the low monetary circulation led to the poor performance, the sluggish performance that was recorded in the sector. So for this, you can see for the full year results, BAT recorded a reduction in their profit by around 19%, while ABL recorded a growth, but it was a very minimal growth. So this is just showing you in terms of revenue. Also, it was an issue. So that's why the performance was not as high as compared to the banking sector. So in terms of profit, the dividend that these two counters pay, both counters have good dividend payment history, and so far BAT has the best one because BAT have been paying averagely 89% of their dividend. So one of the reasons for this is that they have a strong cash flow, and in fact last year, despite poor performance, from their strong cash flow, they managed to pay dividends to their shareholders, and they paid 50, compared almost the same to last year. And since 2018, they have been paying dividends, but for ABL, their dividend average payout rate is around 68%, and also they have been consistent despite the struggle that they have been facing. So this is just showing you these are resilient counters, and you should also have a look at them. Now we move to the next slide. Therefore, we are looking into some of the challenges and also the growth drivers for the manufacturing sector. So we are looking into tailwinds and headwinds. So tailwinds, these are the factors that are supporting growth in for the manufacturing sector. So one of these is the regional subsidiary support. So this mainly applies to EABL. EABL has their subsidiaries in Uganda. They have the Waraji, and also in Tanzania, they have Serengeti. And these are companies these are subsidiaries have been trying to support their growth. And if you look at their half-year results 2025, Tanzania contribute almost 23% of the profit, and Uganda was also almost around 10 or 11% thereabout. So this is showing you that if they take advantage of the subsidiaries, they can witness massive growth in that sector. For BAT, mostly they are in Kenya, but they export to the outside market. Like their export and local consumption is around 50-50. So they also depend on the foreign market for their revenue. Also, there have been like EABL has really relied on digital distribution, this to wholesalers or even to retail to retail clients, and this has also reduced costs and also improved efficiency in terms of delivery and timely order. And also product innovation. We have seen new products in the market. For EABL, last year they introduced products such as the flavored ciders such as the manyatas, and these have really performed quite well. I don't know if maybe you've come across these new brands, Nairobi Summer. Yeah, so it depends. You can check them out. So that these are the new products, and they're trying to relate to the wider client base, the market, those who want alcohol but don't want those they are like the sour kind of alcohol. And also we have also for BAT, they came up with the non-combustible products, just as nicotine pouch. We saw that there was a time there was this product called Velo in the market. Though this sector has been marred by some legal challenges in this self-production, but they intend to come back in the market with them and also continue selling them through import model. Like they import the product and sell it through in Kenya. So that's product innovation, and also is a major growth factor. And also we have strategic partnerships. We've seen BAT partnering with solar companies to reduce the cost of electricity. So this also reduce the expenses and maybe increase the profit margin. In terms of headwinds, these are the factors that have hindered or reduced the growth of the sector. This mostly applies to the entire manufacturing sector. So one is regulation and excise taxes. Regulation, I've just given you an example of how BAT has been finding it difficult to open their nicotine pouch factory in Nairobi, and in fact they had to sell off their stuff because they still have legal issues that need to sort out. And also there's unpredictability in terms of taxation in Kenya. Every year we have finance bill. We don't know what it will have, whether it will be positive or negative. There's a time the manufacturing sector was required to, like for EABL to file the excise tax returns every day, and that was a huge problem. Although they reduced it to 1 week, it's still an issue that should be sorted out. There need to be predictability in the terms of excise tax in terms of taxation policy in the country. So that's a headwind. And also we have witnessed supply chain disruptions and global tension. So this cuts across from Russian war and also Israel and Palestine, and now Trump is in the picture with the tariff wars. This also will impact our exports. And also will impact our exports because we export, like for BAT, they export like 50% of their products, and that's be a major issue. Also, competition and illicit trade. Illicit trade has been a major issue, and for the tobacco sector is covering around 30%. So these are products that are not that are being brought to the country legally. They're not produced through the main channel, and it's giving they're being sold at a cheaper price compared to the products from the BAT or EABL. So that brings price wars because EABL can't match their prices and their price with, so people will go for the cheaper stuff. So that's a major issue. So that's one of these are just the growth and the growth drivers, and also headwinds affecting the sector. So that's why we're done with the manufacturing, and now we move to insurance sector. So insurance in Kenya, people in terms of penetration just showing the number of people covered is still very low at 2.3%. And this also is an issue and also is an opportunity, showing that there's still a huge gap to be filled by insurance companies. There's still so many people that need to be covered. And if any insurance can just do a better job and sensitize people and make insurance affordable, it can be a huge potential opportunity to look into. And for this, that's why we've seen micro insurance companies coming in, and maybe in the villages, in the up countries, to try and align with the other market. So far we have 58 licensed insurance, and in terms of the long-term insurance products, deposit solution is the largest, and medical insurance covers the general insurance. In terms of share performance, there's been a turnaround in the insurance sector. These are and also after the transition from the previous reporting standard to IFRS 17. So for full year performance, we saw Britam and Liberty leading the pack. And the Liberty has been a good performer since 2024, even the previous years, because of the consistent in terms of their profitability. And they also issued a profit last year in 2024, and also that both final dividend, and also they issued a special dividend after they sold their shares in Tanzania. But for Sanlam, Jubilee, and CIC, they recorded losses in 2024. This is mainly because of the below par performance, especially from Sanlam. Sanlam has been making losses like for the last 5 years. They only had a turnaround in 2024. But year to date, because of the positive performance that we've witnessed, we are already all the listed insurance companies have shown year-to-date gains, with the Sanlam recording the highest at 105%, followed by Liberty. So Sanlam, this one of the main issues because of this is the strong performance, the turnaround that we have seen in the market in their financial results, and also they are also doing a rights issue. So expecting to get 2.5 billion from the shareholders. And this one, they expect to at least to improve their balance sheet by paying off debts they owe to Stanbic Bank. So we wait to see how this will turn out, whether it will be a success or not. So that's the share performance. We look into just for here, we're just looking into in terms of their financials. So for the financials, I've only put the percentage growth, not the absolute figures, but just the growth. So insurance revenue, for this one, insurance revenue is just basically the income that's coming from the underwriting, which is the core business of insurance companies. So the premiums that they get, how much, how did they grow? So that's the insurance revenue. It's just showing the premiums as of the period that it has been recognized. So in terms of the premium, the insurance revenue growth, it was positive, except for Liberty. And also for insurance service results, this one is insurance service results. This is the net insurance revenue after I remove the insurance expenses that's involved. So this one for Jubilee, CIC, and Sanlam, they recorded losses, but for Britam and Liberty, it was positive. So this is showing you that the insurance companies are really struggling from their core business, which is insurance. So the main area that saw a massive income was net investment income. So these are the income that's coming from the investments that the companies have made. Because if you give premiums to insurance, they generate more money with it by investing them in various sectors. So far, because this was massive because of what we saw in the markets in 2024. The interest rates were high, so income from government bonds were up, and also the equities market rebounded. We saw from NASI gaining by 34%, so that was also positive. So with this, we saw the PAT, profit after tax, really grew, and the first Sanlam stood out here. But this 935% growth is because Sanlam has been making losses for the years. So they made a loss in 2023 and made a profit in 2024. That's why you see that massive growth. Yeah. And for In terms of dividend payment, the sector has not been so good in terms of dividend payment because they have been struggling. It's only a few that has been making strong performance. But one has been consistent paying dividends, that's Jubilee. And in 2023, they paid 12 shillings. In 2024, they paid 13.5. Liberty also has improved their dividend paying capacity, and they paid a special dividend, as I've said, of 0.5 and a dividend, final dividend of 0.5, totaling their full year dividend of 24 to 1. CIC also paid dividends. They have been also trying to be consistent. Though Britam and Sanlam have not paid dividends. For Sanlam, they are still recovering and they still need to boost their capital position, so they can't still afford to pay dividend right now. So that's for the insurance sector. And with that, we are done with the coverage of the various sectors. We have looked at the, and just before we move to one of the challenges that has been affecting the insurance sector is fraud, especially in medical insurance, and also the low penetration in the market. So people, this has been a major issue here. So if this can be solved, if more people can be signed into insurance, and also reducing the fraud in the market, and also they have been affected by the macros. If the macros are poor, people won't have disposable income, so they won't spend their money in insurance. So with if there's a capacity for these ones to improve, the insurance sector can also improve. But we are seeing a turnaround, and we wait to see what will happen in 2025. And but if we see the way the macros are improving and are stabilizing, there might be a positive performance going into the future. So that's thanks for that. We move on to market trends and summary. What's happening in the market 2025, and how does the information that we have used here, how can they help us to make more informed decisions moving into 2025 and investing in the appropriate areas. So for this year, we're looking into market performance and investor behavior. So as in 2024, we've witnessed the the all-share index performance. There was increased investor wealth because of the rebound in the market, with the market cap the total market cap increasing to around 2.7 trillion. So that was massive. And also, domestic investors were the major participants in the market because there's that renewed confidence and awareness among the domestic investors, both institutional and the retail sector, on how they can invest in the stock market. This is why you see even some of the webinars that we've been doing, like these ones, is just to create that awareness. And NSE has also been doing such to create that awareness and to show people the different ways that they can make money in the market. So domestic investors are improved, but one thing remained constant is that foreign investors' activity was still an issue. Most of them were sellers. In 2024, they sold most of their stocks in 2024, despite the market being on a top or being a top performer that year. So this showing you they're still cautious about the Kenyan market. This is mainly because of one, the political instability that we saw with the finance bill protest, and also the adverse macros that we witnessed, and also the global issues that are happening with the tariff and everything. The global wars, people prefer to have their money in the United States as securities compared to investing in emerging markets. And also, most of the investors are currently focused on dividends, especially retail investors, compared to capital gains. So this is also a trend. And there's been, if you look into into 2025, there's been more keen interest in small cap stocks, such as we have seen Uchumi being at the top gainer. We have seen these small caps like what's it called, Kenya Re. Also, they have been really performing better, even KQ. But we need to, before you invest in a stock, even if it's the performer, you need to understand the company, how they're performing, why is the stock moving that way, and also the volume traded. So you have to be cautious about such. Don't just chase prices, be cautious. And also there was lifting of KQ trading suspension, and at least we saw the price rally after the lifting of the suspension. Because the KQ was initially put to suspension because they were technically insolvent, but at least they have shown a turnaround, and they have started making a operating profit. So wait to see how if the performance will continue or is a one-time thing. And so, as I've said, NSC has also been coming up with investment strategies. They have been creating awareness within the market and also improving the infrastructure. And also they have developed the E20 share index to just show how the East African market performs, the top counters within the East African market. So challenges that persist: political tension, geopolitics, and economic uncertainties within the country. So strategic move to watch out for in 2025. And what some of the announcements that happened in 2024. One, let's look at the merger and acquisition deals. So currently, there's a conversation that started last year about Access Bank, one of the largest banks in Nigeria, acquiring National Bank of Kenya from KCB. So the process is in the final stages with the CBK and the National Treasury. Kenyan side has already approved the sale. So what you're waiting for is for Central Bank of Nigeria to also approve the sale. And the main delay for this was that there was a requirement for the Access Bank to divest from DRC markets. So that's what's holding it on. And also, there's also potential mergers and acquisition in the banking sector. We have 14 banks that are yet to fulfill the monetary requirement to meet the capital threshold. So wait for that also. And also, we are looking at the government trying to privatize some of their parastatals. So this one we might see some of the parastatals will be listed on the NSE to end the drought, with Kenya Pipeline Corporation being one of them. So rights issues are also, last year we saw HF successfully issuing their rights issue, where they got 4.8 billion for capital injection, and this one at least they made them to now they have aligned with the capital requirement. And this year, Sanlam has also issued their rights issue. They were expect to raise 2.5 billion. This one I've mentioned above. And also last year we saw, because of the tough economic environment, we saw some of the companies such as Express and also the ones in agricultural sector issuing profit warning. It's just showing you that profit warning, they were expecting to reduce their profits by 25% compared to the previous year. So that's what has been happening in the market. So finally, everything that we've been saying is just to help us make an informed decision and also pick the best stocks that we can invest in. So the table you're seeing here, I'm not going to go to the table. This is what we usually do at NCBA. Every month we release stock picks, we share it with our shareholders, with our clients. So if you're a client, you will also be seeing the recommendations where we tell you we expect this one to go up by this percentage. You can buy, you can sell, or we are neutral on this. So these ones you can always join us and get the information from this. But if I'm just giving you, I'm concluding my presentation by just giving you 3 stocks that are in different categories that you can pick. One is safe pick. Safe pick, these are stocks that are stable, they issue dividends, and they don't have that aggressive expansion strategy. And one stock that comes to mind for this is Stanchart for me. And Stanchart, they are good at paying dividends, and they're also stable. Then also Growth Peak. Growth Peak, these are companies that they have aggressive strategy of expansion regionally, and also they pay dividend, but not so much because they are retaining some for growth for future expansion. Equity comes to mind. And also turnaround peak. These are stocks that have been performing poorly in the market, but has turned around. And one of them is housing finance. We've seen housing finance has performed well for the last 5 years, but for the last 2 years, 3 years, they have really turned around. They have improved. And also KCB can be part of this. KCB has also improved. And despite them issuing a low payout dividend, we expect them that once the subsidiaries have picked up, they'll pay more dividends. So thank you. And I know we have taken a lot of time, but this is the end of the presentation. Now I'll give it back to Steve. Thank you, guys.
Thank you for that detailed presentation, and yeah, and also ending with those stock recommendations. I would urge anyone who is here to maybe just take a screenshot, even though we shall be sharing these insights. But on the stock recommendations, I have a quick one. Chris, you seem
Yes.
to be favoring the banks. You're not seeing any positives, at least if you if someone were to choose three counters. I thought BAT giving me 50 shillings is a pretty tidy sum. How come they don't feature in your recommended stock picks? At least the top three.
Okay, so Steve,
or even insurance.
thanks for the question. So BAT is not that badly off in terms of we've seen in terms of dividend, they're paying like 89% of dividend. And also in terms of their fundamentals, they are fundamentally strong. And if you look into their performance, the fact that they performed sluggishly in 2024 and 2023 is because of the market, the macroeconomic conditions, because just I've said, they are a consumer company. So if you are looking for a good dividend paying stock, BAT also falls in the same category as Standard. Yeah. And also for insurance, I'm a little bit hesitant to recommend one because we are still witnessing the transition from IFRS 17. So I need to see consistency. Insurance sector has been a little bit more of erratic in nature in terms of performance. Yeah, but Jubilee has been consistent in terms of dividend payment. And also we are seeing Liberty also starting the same trend. They have also been having good performance and also paying dividend, though at a lower ratio. But with the improved performance, we expect them to pay more. Yeah.
Okay. Yeah. Well, thank you for that. And I even noticed that BAT is actually a buy in your sheet, not the top three picks. Okay.
Yeah, it's a buy.
A question, a follow-up question. You have highlighted some of the company announcements that already occurred and some that are coming up. I don't know if you have any ones that you think will be major ones, or that you have seen causing some significant price action. And here I'm talking about whether rights issues, mergers. I don't know if you have one that stood out for last year, as well as one that you think will turn around maybe fortunes of investors this year.
So for this one, like for National Bank of Kenya being acquired by Access Bank, this was announced last year, and it was one of it. If you look at in terms of KCB price, I believe that it has already been priced in, because when it was announced, that's when KCB moved from the 20s up to the levels that are in the 40s. So already this has been priced. So I don't expect it to have a major impact on KCB share price. That's my view, because I think that even yesterday when you saw the press release by CBK and also KCB themselves, the price, there was not so much excitement. The price was a little bit sticky. That's at around 36, 35 thereabout. And moving into what we know for the rice issue, we saw it impacted the chef share price, because most of the markets were a little bit, they were not expecting it for it to be successful, but it was successful. They did a proper marketing and they managed to get enough cash. So this one improved capital adequacy for HF. So once they did this, the share price really improved. It only corrected towards when there was fully announcements by the banks, and HF has not paid dividend, and they don't expect to pay dividend anytime soon, up to around maybe 2029, 2030, because they are still recovering. Yeah. So for for Sanlam also, we have seen Sanlam prices really rally. So this is not only because of the announcement of the rights issue, but because of the performance, but also the rights issue has an impact of this because people are buying into the shares for them to have to qualify to buy the rights. So that's
Okay.
not the impact, yeah.
And to our audience, please be free to share. We have a few minutes left, but we can take a few questions from you guys. And we already have one question from Mumu. He's asking, what about agri stocks? Are they not a strong buy?
So for agri stocks, last year they were hit mainly because of the geopolitical issue that affected the supply chains and because most of the agricultural stocks they produce for the export market. So if there's an issue with the global supply chain, it really impacted them, and also they are dependent on the climate and weather. But moving into 2025, so because if you see the profit warnings that I gave, agricultural stocks were like 4 of them. But moving into 2025, we expect the weather to be good, but now Trump has now come up with a tariff issue. This also going to have an impact on it. But the geopolitics still persist. So I'm not so much enthusiastic about the agricultural sector. But right now, the share prices are a little bit down because if you look at Sasini, it's at around 14. So maybe if you're going into the longer term, don't expect like within a year, maybe just going there for like 2 years, 3 years, thereabout. And if once things settle down, then it can be a good counter to look. It can be a good sector to look into. But with Trump, like America is they have an impact on what happens globally. And right now, Trump has erratic policies. You want to be certain on what he'll be do tomorrow. So, and we export like 90% of products by Sasini, Kakuzi to the export market. Yeah, so that's why I'm not so much keen to recommend agricultural stocks. Yeah.
Okay, cool. And even as we speak about those tariffs, I maybe just want you to very briefly just guide. Do you see, because that's now the biggest geopolitical risk that we're facing right now. Do you see it having any impact on the larger stock market, at least in the for the NSE, these tariff wars?
Yes, because one of the things that foreigners are one of the major participants in the NSC. And with the tariff issues going on, most of the foreigners, they find it safe to have their money in the developed countries because now they are cautious on the developed market. So if foreigners are exiting the emerging markets such as Kenya and also in Africa, we expect the equities market to be a little bit hit. And the rebound that we saw in 2024 might reduce because even if you see so far you've seen year to date, last year has already shown signs of a decline. So this one it will have an impact because we depend on foreigners to move our markets. Stocks such as Safaricom, KCB, Equity, they'll be affected because like Safaricom, they have huge presence of foreigners. Yeah.
Okay,
And
so
if foreigners
the
sell
impact
off,
might not.
yeah.
The impact is on probably the participation of the exchange, but not the actual businesses, right?
Yeah, the actual business. No, the actual business for the actual business, mainly maybe the export. Those are the business that are exporting their products. BAT may be affected in here because BAT export like 50% of their products. And also, if we look into the agricultural stocks, they also export their products. So for them, the business might be affected in terms of revenue. But for the rest, it will be just in terms of sell-offs of the shares because of the cautious nature of the foreign investors.
Okay. There's a question about that you've not mentioned anything about NCBA, including it being even in your recommendation. What's up with that?
So I've not really mentioned
Thank you,
any.
Justus,
That
for
was
that
intentional.
observation.
Yeah, thanks, Justus. That's intentional. Just because I'm trying to be objective, because I work at NCBA,
But it
so
could
to
be
avoid
you're objectively saying NCBA is a good buy.
no, just to avoid the conflict of interest and maybe potential bias. Of course, I can be professional, but just to be sure that I want to avoid the potential bias, we just don't cover it. But I'm sure there are other research houses that have recommendations on it and cover it fully. But for us,
Okay.
is the policy not to touch on it. Yeah.
Oh,
Yeah.
makes sense. Okay, so our final question. In your
Yes.
opinion, what do you think would be the major cause for the banking sector balance sheet decline for the year under review? Do you expect more M&S in this area, rights issues? How do you
Okay.
respond to this? Why do you see that? What are your thoughts on the banking sector balance sheet declines?
So for the decline was in 2024. And as I've stated, the main reason for the decline in 2024, we saw that the interest rate environment was quite high. So first of all, banks were preferred to lend to government. That's what we call now the crowding out effect on the private sector. Now, because banks they were getting high returns from the government, they prefer to lend to give money to the government through the high interest on the government securities. Two was because of the high interest, the high lending rate in the market. So most of the investors could not afford to get loans at such high interest rates, and that's why we witnessed them shying away from that. And also another thing that I've said is that the non-performing loan in the market was really high. This has been caused by the government not paying pending bills amounting to 800 billion. And finally, because of the Kenya shillings appreciating in 2024 by around 20%, if you convert, like the Kenyan banks, tier one banks, have exposure to USD denominated loans of around 30 to 40%. Now, if you convert this loan from USD to Kenya shillings, and the Kenya shillings has appreciated against the USD, the value will reduce. I think I hope I'm clear on that. But now moving into 2025, I don't expect to witness such decline in the balance sheet because one, already the central bank is trying to ease the interest rate environment by ensuring accommodative monetary policy stance. This is by they have been reducing the CBR rate since last year, since quarter four last year. Now we are at 10%. Previously they reduced by 75%. So they are showing you they are intentionally trying to tweak the market to ensure that the credit private sector has really grown. And if the banks have, then the banks have responded though at a sluggish rate by reducing interest rates. So if they can reduce interest rates to affordable levels, more people will borrow and more people will deposit their money with them because there's liquidity in the market. So that's why I've said the decline is not going to be so much moving into 2025. Yeah.
Okay, if you could answer this in maybe just one word, do you see any more M&As or mergers and acquisitions or rights issues for as banks try to show up their capital, as well as maybe if you can comment, of course, I think it was yesterday or today where CBK released a communique saying that they are now allowing them the moratorium about new entrants has been lifted. So speak to that in brief as we close.
Okay, so I think if you there's an article that was saying that like there were about 14 banks who are still yet to meet the required threshold. So the easiest way for them to do this is by one, doing mergers and acquisition or issuing rights. But the route that I think they'll go is MS, mergers and acquisitions, because most of these banks, they are small banks and they don't have that, what we call, that most of the investors are not so much aware of them. So rights issue might not be so positive for them. But MS, I expect to see mergers and acquisitions in the market. Though maybe it will, like for those 14 banks, they have to get capital, and one of the best ways is through MS. And on I also saw the communique. I think it was today on the government lifting the moratorium on the new entrance into the market. So maybe this is just giving an opportunity for other banks to come into Kenyan market, and we are still underbanked. Not so much underbanked. Also, it's balanced, but still there's opportunity for growth, and we just expect it. We wait and see what will happen with that. Yeah, not so much information on that. Yeah. Thanks, Dave. Any other question? Dave, I can't hear you.
Sorry, the good old I'm speaking on mute. So I was saying, as we come to a close, I'll just take this question from this participant.
Okay.
But even then, I'm sharing again the link on Dosika so that you guys can download the app, look at what the different prices of those stocks are. There are even charts that you can find there. You can open a new account, you can buy or sell securities all online through the app. And for this person asking, if Nancy asking whether existing shareholders, whether rights issues are for existing shareholders, yes, they are. If you want to participate in the rights issue, you have to buy it. You have to buy into the share, and then when the rights issue is announced, you can be part of it. If you want more information about when the rights issue there was only one counter that is currently doing a rights issue, which is Sanlam. If you want more information, you can go to our website on www.cdseckenya.com. In fact, let me just share the link for the corporate actions that have been announced for your information. But what are your closing remarks, Chris, even as we end?
Yeah, so my closing remarks is just stock market has opportunities for growth, and don't wait to have maybe a huge sum of money for you to invest. Just start, and there are many brokers in the market, and one of them is NCBA. So at NCBA, we offer best quality services. You can always walk into any of our branches and request for be assisted to open a CDSC account with the CDSC, and also we do also research. So every week, every monthly basis, we provide you with deep coverage of what's happening in the market. And we have our emails it's here on the slide, brokerage@ncbagroup.com or ncbaresearch@ncbagroup.com. You can always email us or even come to our offices and we'll help. And so for moving in 2025, banking sector still has a lot to offer because they are still undervalued. Even also, if you look into the manufacturing sector, the equity sector market has opportunities, so take advantage. And maybe, Steve, I can share we have our WhatsApp channel where you can always find information that
Please share on
the
the
research
chat.
that we've done. So let me share it immediately.
Yes, and you can also share it to our email, and then when we are sharing the presentation to the audience, we shall also share that. So yeah, and that's it for us tonight, guys. Thank you so much for your patience. Thank you for tuning in. Thank you for your questions. Because you made time to join, we shall share this presentation, and the recording shall also be available in 1 or 2 days on our YouTube page at CDSC Kenya. And we hope that this information is useful to you, and you're going to take action through the Dosika app or engaging Chris's team at NCBA. Have a lovely evening, have a good day, and happy holidays. Bye.